Hello everyone, welcome to SK Ramage Official. Hope you all are fine. Today we are here with a new topic. Mutual Funds and Exchange Traded Funds, ETFs, Overview. Mutual funds and exchange traded funds, ETFs, are both investment tools that pool money from multiple investors to invest in a diversified portfolio of assets such as stocks, bonds or other securities. However, they have some key differences in terms of structure, trading, costs, and tax implications. Structure. Mutual funds, investors buy shares directly from the fund company at the fund's net asset value, NAV, at the end of the trading day. The fund manager actively manages the portfolio, deciding which securities to buy and sell based on the fund's investment objectives. ETFs are traded on stock exchanges throughout the trading day, just like individual stocks. Investors buy and sell ETF shares at market prices that may be different from the underlying net asset value. ETFs can track an index passively or be managed actively. Trading. Mutual funds. Transactions for mutual funds are typically processed at the end of the trading day at the fund's NAV. Investors do not know the exact price at which they are buying or selling until after the market closes. ETFs can be traded throughout the trading day, and investors can place limit and stop orders. The price of an ETF can vary from its net asset value due to market demand and supply, leading to potential premiums or discounts. Costs. Mutual funds can have various fees, including management fees, administrative expenses, and potentially sales charges, loads. Some mutual funds have higher expense ratios due to the active management and administrative costs. ETFs tend to have lower expense ratios compared to actively managed mutual funds. This is because many ETFs passively track an index, requiring less active management. Additionally, ETFs often have no sales loads. Tax efficiency. Mutual funds, buying or selling shares of a mutual fund can trigger capital gains taxes for all investors, even if they didn't personally sell their shares. This is because mutual funds must sell securities within the portfolio to meet investor redemptions. ETFs are generally more tax efficient. This is because when an investor buys or sells ETF shares on the exchange, it typically doesn't trigger capital gains for other investors in the fund. Additionally, ETFs have a creation/redemption process that helps manage capital gains. Investment minimums. Some mutual funds have minimum investment requirements, which can vary based on the fund and the type of account, retirement versus regular investment. ETFs are bought and sold like stocks, so there's generally no minimum investment requirement beyond the cost of one share. Both mutual funds and ETFs have their own advantages and disadvantages, and the choice between them depends on individual investment goals, trading preferences, and tax considerations. It's important for investors to thoroughly research and understand the specific features of each before making investment decisions.